Hello and welcome to this session in which we will discuss the concept of inventory. This is an introductory session, so we would look at what is inventory, and specifically we will discuss two concepts, which are periodic inventory system and a perpetual inventory system. So what is inventory? When we say inventory, what are we referring to? So we're referring to anything that the company hold for the purpose of reselling for a profit. Think of merchandisers. Think of companies like Walmart, Costco, Target. Make it simple. Think of your local store or supermarket. Those are merchandisers that holds inventory. So when you go to your local store, to your local supermarket, everything on the shelves is inventory. This is what we mean by inventory. It includes goods that a company either purchases, which is your local supermarket store, or the company could have manufactured that goods with the intent of selling. Think of car manufacturers like Ford Motor Companies, GM, Mercedes, Volvo. What they do is they manufacture their inventory, then they resell it to the consumer. So they also have inventory, but that inventory is manufactured. Now let's make the case why inventory is an asset. We should know this, but let's make the case. It's an asset because it has economic value, and that value provides future benefit. What is the benefit? You can sell it in the future and generate revenues. And we hope, of course, that the revenues that you generated is more than the cost. And we're going to talk about how to keep track of the cost of the inventory. That's important. That's one of the things that we need to learn in this chapter, is how to keep track of the inventory cost. Also in terms of unit, but most importantly in terms of cost. As long as the value exceeds the cost, you sell it at a profit and you create more value for your company. Now, for assets, we have to be a little bit more specific. Are they current assets or are they non-current or long-term? Well, let's think about it. Do we need to convert them into cash quickly? Absolutely. So inventory is a current asset. Why? Because you need to sell it, or you expect to sell it. You want to sell it as soon as possible, but you would expect to sell it within one operating cycle, or 1 year, whichever is longer. We assume 1 year. Because you're going to sell it within 1 year, it is considered a current asset. For companies, the goal is not to keep the inventory. The goal is to sell it even before you receive it. Have the order ready, buy it, then sell it. That's ideal. But sometimes you have to buy it, hold a few days, then sell it, or a few weeks, or sometimes a few months. Nevertheless, you should not be holding your inventory more than a year. So rather, inventory should be sold quickly to generate cash flow and minimize storage and obsolescence cost. Inventory is cost, and we'll talk about the inventory costs later. The longer you keep inventory, the more cost it costs you. In what sense? Think about when you have the inventory. If you have to pay for it, you are tying up your capital. It's sitting on the shelves. You need to use that money somewhere else, so you want to sell it. You're tying up space. That inventory could go bad. It could go bad. It could be stolen. It could go obsolescence. It could go, it becomes obsolete. It's taking risk. You want to sell it as soon as possible. And this is what we will discuss in this session, diving a little bit deeper into how to account for inventory. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
As I mentioned, inventory could be for a merchandisers, could be for a manufacturers. For merchandisers, usually it's one line, like it's called inventory or merchandise inventory. They use a single inventory account because that's all what they have. A company like Walmart, that's all what they have. For manufacturing company, let's assume Tesla, they maintain for example, Tesla, 4 distinct inventory accounts, such as raw material inventory. Raw material inventories are items that they did not put in the production yet. Like what? Like the tires for the car, when they're still tires sitting in the storage room. Radios, they don't use radios, but let's assume computer radios, or sensors. Let's use sensors instead for Tesla. Of course, the batteries. Work in process, when they start to manufacture the car, we call this step work in process or work in progress. Goods that are partially completed during the manufacturing process, not 100% completed. So when they start to put the tires together, the sensors, the batteries, they started the process, but they did not finish yet. What do we call this? It's inventory work in process. Once it's done, once the manufactured car is done, we transfer it to finished goods, and it becomes called finished goods or finished goods inventory, which is completed product ready for sale. And for Tesla, they have a fourth category, service parts, item needed to service vehicles after sale. They believe that that inventory should be kept separately from the manufacturing process. Now, usually traditional companies like Ford Motor Companies, they might only have 3. They don't have a service part, but Tesla is unique, and this is why I wanted to show you a unique example. Walmart will only have 1 line, finished goods inventory. That's all what they have, inventory goods. So let me show you how would Tesla look like from the real world as an example. This is, they would have raw inventory, they will have work in process, they will have finished goods, and have service parts. And there's more information about finished goods. You can go to note 1 in inventory and see it, but we're not gonna dive that much into it. The next thing I want to discuss with you is how does inventory flows within the company's system. This is important. So I'm going to start by using units. So when a company starts a business, let's assume we're selling calculators, or we're selling phones, or we're selling whatever we are selling, units, some sort of units. Use your imagination. For my purpose, I have my wallet in front of me. We're selling wallets. Okay, that's good. So we start with, when we opened the store, we started with 10, let's make it 100. We started with 100 wallets. What is beginning inventory? We assume that the place already existed from the prior period, and we are starting this year with 100 wallets in our inventory. Or this could be a new store, and we bought 100 units to start the business. It doesn't matter. Beginning inventory is, as it suggests, beginning inventory. Now, what do we do throughout the year? We are going to make additional purchases. And let's assume, in addition to those 100 units, throughout the year we purchased 400 wallets. And what I'm using is only units. I'm not using dollar amounts. And the reason I'm not using dollar amounts, because I want to keep this example simple to make the point. We would use the dollar amount later, but there's an important relationship and an important formula I want you to learn here before we dive into the numbers and add more layers. Now, when you take beginning inventory plus purchases, this will give you something we called cost of goods available for sale. In our situation, since we're keeping track of the units of goods available for sale. If I ask you right now, what is our units of goods available for sale? You know it. 500 units, 500 wallets. We have 500 wallets. Now let me ask you, what is going to happen by the end of the year? By the end of the accounting period, we assume a year. What's going to happen is this. Some of these wallets will be sold, and some of them will not be sold. So the units that are not sold will be called ending inventory. And for the sake of our illustration, we are going to assume we have 50 units left in ending inventory. If we have 50 units left, how do you know we have 50 units left? We actually counted them. We asked someone to go open the boxes, count how many units we have left. 50 units. What does that imply? That implies that we have cost of goods sold. It means we got rid of 450 units, and we assume that hopefully we sold them, those 450 units. There's an important relationship here I want you to see. The first relationship is this. Goods available for sale, whether that's going to be a dollar amount or units, it does not matter. It will be split between ending inventory and cost of goods sold. One more time. Units or goods available for sale. whether it's a dollar amount or units, at the end of the year, it will be split between ending inventory and cost of sales. Remember, ending inventory plus cost of sales equal to unit or goods available for sale. Same thing as beginning inventory and purchases equal to units available for sale. You can reconcile just to make sure that ending inventory and cost of goods sold, if you add them up, they should equal to your beginning inventory plus purchases, because both of these are equal to goods available for sale. Goods available for sale. Now another relationship, another important relationship, not only a relationship, an important relationship is the relationship between ending inventory and cost of sales. Let's assume, for the sake of illustration, the person that's doing the count, remember we sent someone to count the units in ending inventory, and by mistake they assumed that we had not 50 units, they counted 75 units. If they counted 75 units, what does that mean? Then we would assume that we sold 425 units. What did that do? This increased our ending inventory and reduced our cost of goods sold. Our cost of goods sold went down by that increase. We increase ending inventory by 25 units. We reduce cost of goods sold by 25 units times the price. Let me show you the opposite. I'm sorry, we increase ending inventory. Now we're going to reduce ending inventory. I'm going to reduce ending inventory to 10 units. I'm going to say when they did the count, now I'm going to reduce it. Rather than 50, they only counted 10 units left. They made a big mistake. 10 units. That's not 20, that's 10. Now, if they counted 10 units left, it means we sold 490 units. So what happened? As we brought ending inventory down, as we brought the count down, cost of sales went up. What do we say? We say there's a negative or inverse relationship between ending inventory and cost of sales. It's very important. There's an inverse or a negative relationship between those two. Now, I want you to know that always ending inventory for this period becomes the beginning inventory of the next period. I know you know this, but it's worth for me mentioning. Since I mentioned this, I'm gonna tell you the relationship, and we'll see that later, between beginning inventory and cost of sales. Now remember, this is the beginning inventory and cost of sales. The relationship between them is a positive. It means if one goes up, the other one goes up. If one is understated, the other one is understated. And that's all what I'm going to say about beginning inventory and cost of sales. I explain ending inventory and cost of sales. Well, if you don't believe me, all what you have to do is do what? Change the numbers and see how it works. Now let's discuss perpetual versus periodic inventory system. Perpetual and periodic are two inventory systems that helps us keep track of our inventory, how to keep track of our inventory. Starting with the perpetual system. The perpetual system, as the word perpetual, it means continuous, suggests that we are continually updating our inventory record. So what does that mean? It means this is a computer system, a computerized system. And these days, it's going to be an AI system, most likely, but it's a computer system. When we purchase the inventory, we debit the inventory directly. So when we make a purchase under the perpetual inventory system, we debit the cost of that purchase to an inventory account directly. When we pay for transportation, freight in, we debit to inventory. So every time we buy inventory, every time we incur any related cost to inventory, what we do is we have, and we're going to see an example, we're going to have an inventory or a merchandise inventory account, and as we make purchases, we will debit this inventory account directly. Any purchase returns and allowances reduce the inventory account directly. So we are keeping track of our inventory cost continuously updated. As we make a sale, we remove inventory from inventory to cost of sales automatically. So when we make a sale, automatically we remove it from inventory and we turn it into cost of goods sold immediately. So everything is updated immediately, inventory as well as cost of sales. Also, Subledgers of individual account are maintained. For example, we would have a general ledger inventory account. Then for every item, we will have a subledger. For example, we keep track of the toasters separately from the plates, separately from the socks, separately from the shirts, separately from the computers. Every item will have its own sub-ledger. This is the perpetual, it's the advanced one. The periodic system. Periodic system means what? Inventory recorded, updated periodically. So when do we know how much inventory we have? When we count. Periodically, we count the inventory, then we know how much. Versus perpetual, continuously knowing exactly how much inventory we have. And talking about the toaster, I remember one time my wife and I, long time ago, we were shopping in a place called, let me remember the place. We're shopping for a toaster. I can think of the place. If I think of it, I would mention it. And we could not find the toaster. So we found a person that's working at the store, and we asked him, do you have this toaster? And TJ Maxx, the store. So he opened a small, tablet he was carrying, and he just put the tablet number. Opened the tablet, put the toaster number, the toaster description, and he told us they had one toaster left. So we kept looking until we found the toaster. Why? They knew exactly how many toasters they had. It was only one. And how did they know this? Because their inventory was updated. So we looked around a little bit, and we found that toaster. Under a periodic, if we found that individual and we asked them, do you have that toaster? Said, I don't know. If it's not there, I would really cannot tell you, because, when was the last time they took inventory? They don't know. So I told my wife, I still remember, I'm going to be using this example when I teach perpetual versus periodic, but this is what it means. So periodic is a manual system. You'll have to go out there and count the inventory. And when you make a purchase, and we're going to see this later on, the purchase are debited to an account called purchases. So notice the difference. The perpetual inventory, when you make a purchase, you debit inventory. Periodic system, when you make a purchase, you debit purchases. Purchase account is basically, it's going to be closed out. We're going to see later, but this is where you park your purchases before you transfer them to inventory. We're going to have a purchase discounts and return. So we're going to have a separate account. So we're going to have an account called purchase. We're going to have an account keeping separately for purchase returns and discount. We're going to have those two separate accounts. Notice everything that we're buying, it's not in inventory yet. It's in purchases. We'll turn it into an inventory later. Purchases, this account that we created, and beginning inventory are closed at the end of the year. So the account purchases that I just showed you, we're going to work an example that we created. It will be closed out. It will be closed out. And basically, it's going to have a debit balance, and it will be closed out. And beginning inventory will have a debit balance. So we're going to sum all purchases plus beginning inventory, and those should equal to the inventory minus ending inventory count to come up with cost of goods sold. So to compute cost of goods sold, we're going to look at beginning inventory. So please look at this formula properly. Beginning inventory plus purchases minus ending equal to cost of goods sold, which is the same picture that I just showed you here. Same exact picture. Let me show you this one more time here. Beginning inventory plus purchases minus whatever this number happens to be. If this number is 1,000 and this number is 200, 1,000 minus 200 equal to cost of goods sold of 800. Same exact thing. Beginning inventory plus purchases equal to cost of goods sold. And this is the formula, an important formula for cost of goods sold. Know this formula. Study this formula. Study it. Know it. This is important. This is going to make your life much easier in your advanced courses. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following inventory system is a purchases account used to accumulate the amount of inventory purchased during a particular year? So, how many inventory systems do we have? Two. We have a perpetual inventory system and we have a periodic. When we use the account, none of the above is not an answer. It's not a correct answer. So when we use the account purchases, when we make a purchase, are we using a periodic system, or are we using a perpetual, or can we use a periodic or perpetual? You cannot use periodic or perpetual. You have to make a decision. When you make a purchase for your inventory and you account to it as a purchase rather than an inventory, you are using a periodic inventory system, not perpetual. Under a perpetual system, when you make a purchase, you debit inventory, not purchases. Under a periodic inventory system, when you make a purchase, you accumulate the purchase of that inventory under an account called purchases account. Differences: two different accounting systems. One is a periodic, one is a perpetual. You need to know its feature, advantages, disadvantages, and how to do accounting. What should you do now? You want to go to farhatlectures.com, look at additional resources, multiple choice, true false, lectures, exercises, anything that you can find, whether you are an accounting student, a CPA exam candidate, CMA candidate, studying for any professional certification. The best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.